idiots. Hi guys, I'm just going to give you a few seconds to enter the room, and we'll get this webinar underway. Okay, quite a good turnout today. Excellent for this evening for me. Fantastic. Okay, guys. So look, as usual, a warm welcome from me and the FP Markets team. Thank you all for taking the time out of your day or evening to be with us. As I said, I see some regular faces present, and my mouse has just stopped working. Okay, there we go. So for those who are new, my name's Aaron Hill, and I'm one of the market analysts here at FP Markets. Right. So yes, one of the analysts from FP Markets. Look, I take it we can all see the welcome slide on the screen and hear me loud and clear. Any issues, guys, please do let me know, and we'll try and get things sorted for you. Bear with me. I don't see any fantastic. Thank you, Bertha. Excellent. Good to see you again, by the way, or good to see your name again. Right. Okay. Right. For this presentation, the focus is on higher time frame structure, the higher time frames. Now, I'm going to assume we're all familiar with, thank you, Tim. We're all familiar with higher time frame structure. We're all familiar with basic chart features. And let me just sort out my mic, bear with me. There we go. We're all familiar with chart features and, you know, basic technical analysis. If not, please feel free to watch my the previous webinars created by me and some of my colleagues, which highlight technical studies. Hi, Dante. Right, so on to the disclaimer. Look, guys, I'm not really going to say much about the disclaimer. It's simply trade responsibly. Derivative products are highly leveraged. They carry a high level of risk and are not suitable for all investors. So look, essentially, you know, features of our products, including fees and charges, are outlined in the relevant legal documents available on our website. Okay, for anyone that doesn't know who I am, this is just a very quick introduction of myself. I'm the technical analyst for FP Markets. I've been involved in the financial markets for more than 12 years now. I recently became a CMT, a Chartered Market Technician, and on the back of that, I also received the CFTe qualification. Just to confirm, once you complete level 2 of the CMT program, you are eligible for the CFTe qualification. For me personally, I love price action. I'm very passionate about price action. When I say price action, I'm not talking about Japanese candlesticks. Of course, that does fall under the umbrella of price action, but there's a lot more to it. I also really like Fibonacci studies. The relative strength index is always handy to have on the chart, as you'll see very soon. And I also look at chart psychology. Now, in terms of the agenda for this evening's presentation. So look, first on the scales, there'll be a brief introduction to timeframes. Look, I included this section here as some newer traders may not fully understand the meaning of a time frame in the trading arena. Next up, is there a best time frame to focus on? What's your trading style? Here I'll also be touching on the most common trading styles. Look, there's only 4 really, but with the majority of the focus, obviously, for this presentation will be on the higher time frames. But you know, the best time frame is dependent, you know, on a number of factors. Therefore, this presentation will be interesting for newer traders, essentially just getting their feet wet. We'll then switch things over to a higher time frame direction, which while some traders focus solely on higher time frames to trade, which is absolutely fine, by the way. I actually know a couple of traders who do very nicely just trading the bigger picture. That's not including the lower timeframes. That's just trading the higher timeframes. But higher timeframes, as I use them, higher timeframes also have use on the lower timeframes, which is something I try to show in my weekly and daily market analysis, which I obviously will go through at the end. Look, and finally, although it's not demonstrated on the screen, there will be a Q&A section at the end if there's any questions that may arise or I don't answer them throughout the presentation. Again, if any arise, you may understand all of what I say and what I show and demonstrate, and that's fantastic. Look, as in each webinar, I like to try and get through each question, but if time runs out, please feel free to email me and the research team at marketanalyst@fpmarkets.com, or alternatively, guys, support team at fpmarkets.com. That will be in the chat box right now, guys. And look, we'll get back to you as soon as we possibly can. Additionally, feel free to send over your ideas and our ideas for future presentations. Look, if there's enough demand for that subject, we'll look at putting something together for you, and hopefully it will help my fellow traders. Additionally, look, please also remember there is a recording for the presentations, and they are available through the FP Markets website under resources, and it's also posted on FPM's YouTube channel. Okay, so look, timeframes. As I'm sure you're very familiar with the platform on the screen right now. Look, a time frame simply refers to a period that like a candle or a bar open between the open and close. Okay, so that probably didn't make much sense, but so a time frame essentially refers to a period. Let me just see. Okay, excellent. No questions. So look, on MT4, there are 9 time frames, right? As you can see here very clearly, from the M1 to the monthly time frame. In total, there are 9 time frames, okay, for you to use on the MT4 platform. As I said, from the monthly, weekly, daily, H4, H1, right down to the 1 minute time frame. Look, for me personally, this is enough. I don't need any other time frames than this. But look, while on MT5, which is not showing here, we do also have access to 21 different time frames. Again, look, I'm not showing this on the screen, but they will appear here at this point here. So with the MT5, we have the option of having things like 12-hour candles, 3-hour candles, and even 3-minute candles. Look, for the real die-hard price action enthusiasts, that could be of use. But for me, this is enough. This is all I need. Right. So look, there's really not much else I can say about the time frames, other than what I've said. If there's any questions, please do. Anything I've not covered in terms of time frames, please feel free to ask away right now. Okay. So look, moving over to what's known as trading style. I'm sure you've all heard of this this term. It's commonly used across all of the trading forums. So look, ultimately, 4 main trading styles exist. And we have, as you can see on the screen, we have scalping, we have day trading, we have swing trading, and we have position trading. Scalping trades are only held for, a few seconds at times, or or generally only at most a few minutes. This is not for the scalping is not for the faint of heart. It really is not. Traders that fall under this umbrella, so scalpers, tend to take numerous trades each day. So they're in front of the screen almost all day, and they take trades. So they close out their trades before the end of the day. Look, there's another term. You can also scalping is also linked with what's known as market makers. So when a market maker buys at the bid, So for instance, when we want to sell as traders, a market maker will be buying at the bid. So they will buy at the bid and they will sell at the offer. They will try to. That's their aim, right? So they buy it and sell between the bid. So that's called scalping as well. That's another way of describing scalping. Next up, we have day trading. Day traders are those traders that hold positions for anywhere from a few minutes to a couple of hours. Look, the defining point for this category is that day traders usually liquidate their positions before the close of trade for the day, which is obviously the New York close at 5 p.m. Eastern Standard Time. For me, that's currently 10 p.m., I believe, 10 p.m., 9 p.m. I'm not sure the actual time at the moment. It's 4 hours difference. I think it's 9 p.m. for currently for the British time. Look, swing trading. Swing trades are usually held for a handful of days. Now, sometimes even a few weeks or even up to a month. You will find that swing traders favor the medium-term timeframes. Next up, we have, finally, we have position traders or position trading. Look, position traders, position trades are held anywhere from a few days to, well, at the extreme, even a few years. And this can also be referred to as investing. Look, in terms of timeframes, a scalper will usually be watching the M5 and M1 timeframes. Look, day traders, they will also look at the 5-minute time frame as well, but they'll also look at the 15-minute time frames, the H1 time frames. Swing trading, now that generally focuses on the H1 time frames, H4 time frames, and sometimes even the daily time frames to gauge trend. While position trading, this is more of an investment approach in my experience, and this really places emphasis on the daily, weekly, and even monthly candles. Okay, the position trader, as you can see on the screen. Now, as far as I've seen over the years, the appeal towards position trading continues to grow. As its name implies, position trading involves taking a position in a security, in a currency pair, assuming we're talking about FX here. So the ultimate goal, of course, is to jump on the back of a major trend. Patience and discipline, of course, is key. It's key within every trading style, to be quite frank. But position trading, you need to have the patience to hold your positions for longer durations. Now, focuses on the bigger picture. Now, this is pretty much self-explanatory. Position traders don't tend to focus on market blips, meaning the minor retracements or the intraday pullbacks or retracements. They focus on the bigger picture, the higher time frames. So look, ideal for those with full-time commitments. Now, look, as I'm sure you can imagine, the appeal to position trading is for those who work full-time jobs. Actually, having a full-time income can help lessen the psychological impact of trading, as many full-time traders, they actually need to make money. They actually need to take money from the markets, and that need can result in a number of psychological issues that affect the trader's performance. But look, you can also say the same about swing trading alongside position trading. Less time at the screen. It's just ideal for those with full-time commitments. Now, with full-time commitments, you could be a full-time parent, so you can't be at the screen all the time. So it's not just with your occupation, your jobs and things like that. So it's ideal for those with full-time obligations. And look, less screen time. Look, I've pretty much covered that. It's less screen time as a position trader. You don't have to be at the screen all day, of course. You can just check the charts maybe once in the morning and once in the evening before you go to bed, just to check your positions are okay, they're doing okay, and if there's any new positions that need to be opened or current positions that need to be closed or modified. Less trades. Look, again, pretty, it's pretty much, it's pretty obvious, right? Less trades. When you're on the higher time frames, you're going to have less trades. So less trades, and as you can see here, less stress. Unless you're one of these that focuses on, I'm trying to think of the words to use. Unless you're one of these people that cannot let the market go, like once you switch off your computer, that's it. You should forget about what's going on and try and switch off. That's the word I'm looking for. So with position trading, you have a trade on, and that's it. Your trade is on, and you check it once or twice a day, and that's it. Then you get on with your other commitments. So yes, that's really all it really boils down to with position trading. Now, guys, it's not all sunshine and roses with position trading, of course. Like any trading style or trading method, we have downsides. Now, a clear downside, as you can see here, is exposure. While it's true that holding an open position in a market for a longer period does increase the chances of catching that big trend, being exposed to the market itself is inherently risky. Remaining active in a market for long periods of time increases the chances of experiencing heightened degrees of volatility and risk. Has anyone heard of a black swan event? Now, if you're in the market, if you're exposed to the market for long periods of time, your chances of suffering from a black swan event is obviously increased, right? So this is something to be aware of. Now, when I say a black swan event, I'm talking about things like back in 2015, when the Swiss bank, I cannot remember the details now, but when the Swiss bank, I think it was unpegged the euro or something like that, and the currency just sunk. That's a black swan event. Now, if you was caught on the wrong side of that, that could have been, particularly damaging for your account and your psychological mindset. Another point, of course, worth highlighting is time. So look, holding a position long term requires a trader or investor to allocate capital for a substantial amount of time, right? So the initial capital outlay, the money required to facilitate the transaction, including margin requirements, is effectively off the table until the position is closed out. So this can lead to what's known as opportunity cost, where the trader or investor is unable to pursue other opportunities because sufficient funds are not available because they're already committed to the market. Of course, there's also we have to include, although I haven't got it written down here, we also have to include swaps. Now, if you have a negative swap, that's going to chip away at your profits. So we need to also take that into consideration if you're considering long-term positions. Okay. So look, which is the best time frame to trade or focus on? You'll be surprised how many times I get asked this question. What is the best time frame? I've been asked it countless times. So look, while I would love to be able to direct you to a specific time frame and say this time frame is the better option, it's just simply not possible. It ultimately depends on you, right? Your individual circumstances. If anyone here does know of a universal time frame suitable for all of us, please do let me know, because I guarantee you there is not one. We're all different. We all have different lifestyles and commitments, and this affects which trading style we select. And so look, as an example, having full-time commitments usually places you in the swing trading or position trading bucket, as your screen time is obviously going to be limited. Though, let me just check 1 second. I'm a victim of margin loss. Dante, can you maybe expand on that? What do you mean? You're a victim of the swap, maybe? swap being priced against you, a long-term trade maybe. I'm not sure what you mean by margin loss. You mean you went in too heavy, maybe with the leverage or something? Oh, so you're a long-term trader that's affected by the swap. Yeah, that's certainly something we need to take into consideration if you're looking at becoming a position trader. Look, so what if you have spare time during the day, right? So say you work part-time or are retired, then day trading or even scalping can be could be options. So I wish I could provide more of a defined answer, but which time frame and ultimately which trading style you choose really depends on your own personal settings. Now, if you were to tell me you were in university, you're a young guy or a young girl, a young woman, and you're in university and you've got 2 to 3 hours spare each day, you could potentially day trade during those hours. You could potentially scalp during those hours if you were committed. And yeah, so there's a number of ways you can engage with the market. But look, there's no one correct answer applicable to everyone as far as I know. The common goal among traders, right? So I thought it may be worth running over other trade. I thought it might be best for me to really expand on the other trading styles as we've largely focused on position trading so far. So Dante says, I'm not sure if you guys can see what Dante's wrote, but he said, I leave my position on for a long time because he's working. Yeah, so how's that working out for you, Dante? How's that? I mean, are you profitable long term? How's that going for you? So we have a question from Benson. Good evening. What time frame is good for analysis? I don't know, Benson. I really don't know. It depends on you, right? Oh, good for analysis. Oh, bear with me. Sorry, I read your question incorrectly. Look, Benson, I'll get back to your question as soon as I can when we hit the charts, and this may give you an idea. Right. Look, let me just quickly go over some of these trading styles, and then we'll hit the chart. So look, swing trading, as you can see here in the colored nicely in green, swing trading ultimately involves identifying swings, right? Swings within a trend, then attempting to capture the swings within the trend. So it's worth pointing out the term trend can be confusing to some newer traders. Look, a trend is not only found on the higher time frames. The market is fractal, which means trends form on the 1 minute time frame right up to the 1 month time frame, onto the monthly time frame. But for here, swing trading, I'm really referring to H1 and H4 and daily time frames for swing trading. So swing traders tend to look for strongly trending markets, as we all do, I guess, and trade the retracements and pullbacks. I am sure some of us have heard the terms. Well, I hope you have terms buy the dips and sell the rallies, or sell on rally. And this is what I'm referring to. So as the market comes, let me just show you on the screen. So as the market comes down, we're in a trend, we look to buy the dip, and as the market's moving lower, we look to sell on the pullbacks. So we sell on the rallies. Some of the downsides for swing trading, similar to position trading, of course, are exposure to overnight and weekend gaps. Also, as you only focus on capturing these swings, traders taking trades in a single day usually traders can miss out on a lot of profit by using swing trading, as with the position trades you're riding the trend, right? So but with the swings you're trying to capture small swings within the trend, so you can potentially miss out on a large part of the trend. Now, day trading, as you can see here in yellow, day trading, as the name suggests, involves taking trades in a single day, usually based on some form of technical analysis. Now, day traders typically do not keep positions open overnight, hence the term day trading. Scalpers and day traders also generally want account types with low spreads, as this enables more profits. Some of the downsides of day trading are, similar to scalping, is that you require relatively good timing. I'm sure you're aware, for anyone that does trade on the lower time frames, timing is imperative. And, as I said, it's not for the faint of heart. It doesn't accommodate itself well to those who prefer slow-moving markets. You must be able to execute trades sometimes with speed and confidence at areas or your trading system deems a higher probability zone. Day trading, look, much like scalping again, can also be, can be really emotionally taxing. I'm sure most of here can attest to this. Watching your P&L go up and down can really play games with you. Short-term trading generally requires the trader to be present at the screen, not like my friend Dante there, who leaves his positions open while he's at work and things like that. So he's probably not watching the P&L as much as someone that would be if they were day trading or scalping. One alternative is I knew a trader that used to cover his P&L. Just put a bit of tape over the screen and he covered his P&L and it seemed to help him, he said. Look, finally, scalpers. So scalping in the black there. They ultimately target minor fluctuations in the market, entering and exiting trades multiple times per day to build profits. And it's usually at an inverse risk reward. What I mean by that is the scalper will come in and risk $100 to make $70 or $50. But if you can do that enough times with a high win percentage, a high win ratio, then you will make money scalping. So look, scalping, for me, it's really best suited for those who have the time to devote to the screens and are able to stay focused and act swiftly. It's usually said that impatient people make good scalpers, as they tend to exit from a trade quickly after it becomes profitable. Key attributes of a scalper are those that can handle stress and act under pressure. Now, I won't go into any more detail really with this. Are there any other questions? Nothing else. Okay. So what I'm going to do, guys, is understand higher time frame direction, right? So, and its use on lower time frames. Let me just switch over to the charts. Bear with me. Okay, we're now on the charts. Just let me know quickly in the chat box, guys. Do me a favor and just type Y or N for yes or no if you can see my charts right now. I'm currently looking at euro dollar. Just get rid of the... Yes, thank you, Bertha. Excellent. So right now, look, guys, we are looking at the euro dollar. These are the charts. This is the charts. The way I analyze the charts for the daily and weekly market analysis. So this is the weekly time frame, and this is the daily time frame. So weekly, daily. This is my higher time frame gauge. This is where I want to know where I am on the bigger picture. This is the H4 time frame, and this is the H1 time frame. So this is my short term gauge. Right. So I'm going to kick off with the weekly time frame and let's decipher where we are. So weekly time frame. As you can see, let's ignore. Look, longer term we are lower, right? We don't need to be rocket scientists to see that. Lower lows, lower highs, lower lows, lower highs. We have been in a range since around 2017, though. As you can see, we've been ranging with not much in terms of definitive trending action compared to this area. If we compare to this is very, very long term that way, guys. But look, if we focus on the more immediate flow, as you can see from the beginning of January 2021, we have been in a downtrend. There's a number of cues to say that we are in a clear downtrend. This is the primary trend for anyone that follows Dow theory. Primary trend consisting of lower lows, lower highs, lower lows, lower highs, and a series of lower lows and lower highs. Now, of late, I'm not sure if any of you guys read my daily market analysis, but I did highlight that we had a textbook bullish engulfing pattern. Now, why this is a textbook bullish engulfing pattern is because you might be thinking, well, hold on, that's not, I'm talking about this. Let me highlight this bit here, these two candles there. Why is that an engulfing pattern? You'll often see so many traders state that it's an engulfing pattern when it's, if they look at the textbooks and things like that. Whoops, sorry guys. Right, so if you look at the textbook and you'll find that the bullish and bearish engulfing patterns are more focused towards the candle bodies. Okay, so it's the real bodies of the candle. So as you can see, we opened lower than the close of the prior weekly candle and we closed higher. So it's the candle bodies we're looking at. So this is a textbook bullish engulfing pattern. All right. It doesn't matter that the lower shadow did not engulf the prior lower shadow. Okay, so if you want any more information on this, do let me know and I'll try and go over it a little bit more. But as you can see, we have currently strong follow through upside on the euro dollar weekly time frame from this, and we're currently up by 1.6%. Right. So sorry about that, guys. I muted myself. Sorry. Right. So we have a bullish engulfing pattern on the weekly time frame, and we have follow through upside. Clear, easy. Everyone can see that. No problems. But we are in a downtrend. So what does this mean? If we're in a downtrend and we have a bullish engulfing pattern, look, this could mean we are heading higher on the euro with the follow through upside we've seen. But look, we have a Quasimodo support term resistance at, just click on that, at 0.778. Okay. And this is a possible zone area we may see sellers come in from. Okay, sell on rally scenario may appear from here, so take that into consideration. This is the bigger picture telling you what's going on. Okay, right, so with that in mind, let's go down to the daily time frame. This is the daily time frame. Now for the pandemic low, which was 0.638, we are now back above that. It was initially resistance on the earlier in May. It did form a resistance, and we did also. This also shows why it's. We had a. This is not a bearish engulfing pattern here. This is a bearish outside reversal because of the. We're focused more on the upper shadow and lower shadow here. But even that, there's not much of a trend preceding that, which is one of the requirements for the bullish and bearish engulfing and outside reversals. Now we have come above the pandemic low, which is, which is bullish, right? So the next target for this market on the daily time frame is around the 0.839. So we have some room to move to the upside on the daily time frame. In line with this, we also see that the RSI is now above the 50 center line, which shows us that we have positive momentum in this market. So if you're a position trader, you could just focus just on these two time frames, right? Just on these two time frames. You could be looking, because we're in a clear downtrend, right? Because we have resistance, ascending support term resistance around 0.818, and we have weekly resistance at 0.778. Between these two areas, we have a strong resistance zone. Okay. And alongside this, we'll likely have the RSI hitting, touching gloves with resistance, right? 63, 66. So there we have a position trade, a potential trade to enter short along with the overall primary bear market at the moment. Okay, so that's if you're a position trader. Now, if you want to go down to the lower time frames to get a better entry, you can. Now, I haven't updated these charts since yesterday's analysis. Look, we are now above the 0.7, the 107 figure on the H1 timeframe. Now, that look, if we're above a psychological level, this is bullish, right? So this adds to the confidence that we have room to move higher on the bigger picture until we reach the weekly resistance and daily time frame resistance. Okay, so there could be, with that being said, there could be an option for a short-term bullish position within this market, because look, higher time frames, we've broken out of an ascending channel, bullish. We're higher. We've broken out of a trend line resistance on the H4 time frame, bullish. So we have short-term bullish price action being seen. So look, for the euro, we could look at taking a bullish position. I believe this was noted in my analysis as well. Short term, we are looking at a bullish upside, an upside move, but do be aware, once we reach these areas on the bigger picture, we could see strong selling interest emerge. So there was a question from Benson. Which time frame is good for analysis? I hope this helped answer the question, Benson. For me, my time frames, what I prefer during my market analysis is obviously the weekly time frame, the daily time frame to gauge the bigger picture. And look, you can take trades just from these two time frames. If you're a position trader, you might also want to include the monthly time frame as well, just to add a little bit more confluence. But yes, if you're a position trader, you could just look at, and that's it. My mouse is completely frozen. I apologize for this. And you could just use the daily time frame and the weekly time frame to generate trades. Now, if we move over to the Aussie dollar, now the Aussie dollar, let me try and find another. This is a really cool chart, the dollar yen. Look, if you guys read my market analysis or you're familiar with it, go back to yesterday's market analysis. Price was dancing with this H4 level, right? So I'll just quickly explain where I am. On the dollar yen, this is the weekly time frame. As you can see, look, we have a clear uptrend, right? The primary trend is higher. Now, the correction, this is a secondary trend, okay? The correction seen here is the largest correction seen within this uptrend, okay? So it's pretty serious stuff for the dollar. But look, we have weekly support at 125.54. So this could be an ideal location to be looking for dip buying opportunities. Same is seen on the daily time frame. Now, I know that there's room for although we're in an uptrend, I know from the bigger picture, from the daily, from the weekly time frame and the daily time frame, we have room to move lower. Okay, we have room for sellers to come in. Now, what do we see on? Let me just get rid of the cursor. What do we see on the H4 time frame? We see a double top pattern, right? Textbook double top pattern. As you can see, we broke the double top pattern on the 12th of May. And since then, we connected with this H4 Quasimodo resistance, Quasimodo support at 127.44. Now, it was around here. Price was, not showing much in terms of bullish interest. Why? Because we know on the bigger picture, there's room for sellers to work. Okay. So by knowing this, I did note in the market analysis that higher time frames often precede the lower time frames, right? They often guide our short-term flow, right? So if there's room to move lower on the bigger picture, there could be a really good shorting opportunity. Anyway, I stated that in order for the H4 candles to reach its pattern profit objective, the double top pattern profit objective at 126, we would need to engulf this 127.44 Quasimodo support, and we did do that. But how did we know that was a very high probability of happening? It's quite simple. Look at the higher time frames, right? Look, if you're a position trader, you'll be still sitting on your hands at this point, assuming you have no position, and you'll be looking at the support at 125.54, the weekly support, as a possible dip buying area. Now, as we know from the H4 time frame, we have broken this Quasimodo support, and we are on the doorstep of this pattern profit objective. But look where the pattern profit objective is. It's right above our weekly support at 125.54 here and seen here. Okay, so between this pattern profit objective, this weekly support, and this H4 support, now we have a zone to work with. We got, 1 second. Where's my squares? There we go. We have a zone to work with, a zone of support where we can analyze price action within this area to see if there's any bullish, any bullish interest. If there is, this could be an ideal location to be looking for buying bullish setups because of where we are on the bigger picture. Okay, I hope I haven't confused anyone here. I know this is a position trading webinar, but I'm just trying to open your eyes to if you include the higher timeframes, you can also look at lower timeframes for possible setups. Okay, look, let's see if there's anything on the right. Let's look at the daily. Let's look at the pound dollar. Let me get rid of the crosshairs. Okay, right. Now I will say this about the pound dollar. In the many years I've been watching the charts, the trend line supports are just so good. Textbook trend line supports, textbook trend line resistance are so reactive on the pound. Look at that. Look at this. I think I said in my daily market analysis for today, if we do hold below the 126, do keep an eye on the 125 figure because of the trend line convergence. Look at this, just pit perfect of what happened here. And look for the 125 figure. What happens around the 125 figure? We know traders are going to be placing orders. We know there will be. Look at this strong move here. Now, do you think the strong sell-off at this point that broke this round number would attract bearish breakout sellers? It would. It's guaranteed to attract breakout sellers because they think it's going to continue. But what you've done is you've sold directly into a very high probability trend line support. Now, could price have continued lower? Yes, it could. 100% it could have continued lower, and the breakout sellers would have been patting themselves on the back and congratulating themselves, you know, how well they caught it. But in this instance, if you know you have a high probability trend line support, it's probably not worth taking. And what's occurred here is what's known as a bear trap. Okay, look, I've gone off on a tangent here, but just be aware of the trend line supports on the pound dollar. Look, longer term, another weekly bullish engulfing candle seen on the weekly bullish engulfing candle at this point here. Weekly bullish engulfing candle. So we know we're bullish, right? We know. My mouse has completely stopped. Just bear with me, guys. We have a question from Dante. Are you putting a stop loss in your trades? I'll ask you that question, Dante. Are you putting a stop loss in your trades? If you can answer me, I would really appreciate it. Guys, if any of you want to answer that, please do. How many of you use stop losses in your trading? How many of you use mental stop losses in your trading? And how many of you are disciplined enough to react if you're using the mental stop loss? Please do let me know, guys, in the chat box. So as you can see, look, the weekly time frame, the upper chart. Yes, Bertha, thank you very much. You should use a stop loss. Yes, 100% you should. And to answer your question, Dante, before you answer, yes, I do. I always use a stop loss because it's technically it's called a protective stop loss. It's there to keep you honest. It's there to keep you right. So I'll just give you an example. Right, so I'm just a bit distracted by Tim's answer. No stop loss. If it goes out, I turn it into a swing trade. Now that is fantastic. If you have the discipline to do that. I don't meet many people that can do that. But if you have the discipline to do that, the only thing look, a stop loss does not guarantee that it's going to protect you, right? Because if you have a high my brain's absolutely fried today, but just give me a second. If you have a very volatile move that's goes through your stop, it can actually jump above or below your stop loss, right? So you can actually get out at a worse price than. But look, it will still help you. I'd prefer still to have a stop loss because it will get you out the next best available price. But if you didn't have a stop loss and you have a black swan event, that's the end of your account. It's pretty much the end of your account, I would say. I just don't see the look, I know other traders that don't work with stop losses and they're successful. So who am I to say? But it's just my personal opinion here, guys. I always work with a stop loss. It just keeps me honest. And look, for those that do work with stop losses and then do move and then find themselves moving their stop losses, this negates every single thing, every all of your analysis, right? So you analyze, this is the best place to enter, this is the best place to exit. But if you start moving your stop loss away from your position because you're fearful of taking a loss, you are doing nothing more than gambling there. And it's a very, very bad habit, and one you should not adopt, if that makes sense. Keep the stop loss where it is, because you analyze that. When you analyze your trade, you analyze that from an objective standpoint. When you're involved in a trade, the emotions can really affect how you engage with the market. So I always think about it like that. When I analyze the charts, I'm very objective. I have no money on the line. And I'm looking at the charts. I think this is the best place to get in. This is the best place to get out. If I'm wrong, so what if I'm wrong? Out of 100 trades, so what if one trade, two trades, three trades in a row are wrong? Think about it. In the grand scheme of things, 1, 2, 3, even 4 consecutive trades wrong. What does it matter if the risk is controlled and you work with a decent enough risk-reward ratio? What's to worry about? Do I use fractals for trading on the higher? What do you mean by fractals, Alf? I'm sorry, ALF. I'm not sure what you mean by fractals. Is that the indicator? If so, I don't use that indicator, no. Right, so look, there's not really much else I can say other than what I've already said regarding this. 1 second, let me see. The indicator, no, I don't. No, I have heard of it. I did look into it for a few, for an hour or so, if I remember correctly, but no, I haven't included that in my trading. Look, as I said at the beginning, I'm more of a price action trader, and yeah, there's so much you can do with price action. And look, indicators are a derivative of price, right? The RSI is a derivative of price. Look, I'll give you a clear demonstration here. Let me just get the daily time frame up. So we're using the RSI here, right? So here we can see clear downside momentum, very, very strong, right? Look at this area compared to this area here. Strong downside momentum, weaker downside momentum. What does that cause? That causes divergence, bullish divergence. Okay, so we have downside momentum downside momentum slowing, okay, in comparison to its prior price action. Okay, so you can see this on the chart. Once you have more experience, some of the experienced traders here may even be able to see. I just use the RSI indicator because it just tells me straight away that there's some potential bullish divergence showing here. And so they're all derivatives of price. We have a question here. Does the different time frame analysis work for trading stock markets? Of course it does. The NASDAQ, of course it does. 100% it does. It's called a multi-time frame approach, right? It's always good to know where you are in the bigger picture, right? So if you're trading into weekly support, you don't really want to be selling at that point. It's just not worth the risk. And if you're trading into, a daily resistance, a strong daily resistance, why would you want to buy? You'll find a lot of breakout buyers get caught out by that. So they'll buy a break of, say, a round number on the lower time frame. And I'm trying to find an example. I don't think I have one. But there's been a number of times where price has traded to the round number on the H1 time frame, and there's a daily resistance just above here, and you'll get breakout buyers committing above this area. And why not? Momentum trading is pretty. Breakout trading can be profitable in the right locations. But what they've done is they've bought into a daily resistance. Now, it's not to say that it definitely won't work, but there's a very good chance that daily sellers will slam into all of those breakout buy orders. And what they're getting is all those buy orders, filling those offers, filling those higher time frame offers. And in the end, once all the breakout buying dries up, price drops. Okay. So yeah. Any other questions, guys? I'm going to spin things back to the to the, right, okay. So any other questions? All right, while I'm rounding things off, do ask any questions if you have any, and I'll answer them before I switch off. So look, I sincerely hope this was helpful to some of the newer traders here, and they're able to walk away from this presentation more knowledgeable. Look, upcoming webinars, we're now switching to 4 webinars per month now. So upcoming webinars for June are an introduction, and these are all at the same time, guys. Introduction to technical indicators. That's on the 7th of June. Then we have what is an economic calendar and how the traders use it on the 14th. Position sizing. Do make sure to be there for that. Position sizing, understanding how to correctly calculate your currency trades on the 21st, and then the importance of a trading plan, the basics, and that's on the 28th. Okay, I see some questions. Right. Okay, there's no questions. Dante, like that. I'm not sure what you mean by that. Is that a question or? Okay. Okay, Benson, what MA do you use to help analyze the trade? No, I don't really use an MA. I don't really use the moving averages, to be quite frank with you. I do have the, as you can, well, you can't see it on the other slide now, but I do use the 200-day simple moving average. I would never use it to base a trading decision on, but some traders do use that. I have the 200-day SMA on there just for really trend direction, and because I know a lot of traders use it, that's mainly why it's on there. You can also use the 50-day simple moving average alongside the 200-day simple moving average and look for crossovers. If you're looking for a very basic setup, a long-term setup, that's something you could look at. Right. Oh, you're very welcome, Tim. You're very welcome. Thank you very much. Right. So look, if there are any specific topics you would like the team here to talk about, please be sure to send in your suggestions to the emails are there, support@fpmarkets.com, or look, guys, marketanalyst@fpmarkets.com. Also, be sure to register for the FP Markets Telegram channel to get instant updates. The sign up tab can be found in the chat box, or alternatively on the lower left part of the FP Markets website. Let me just check if there's any. You're very welcome, Bertha. Thank you very much for joining again. You're very welcome, Ahmed. I'm so sorry if I've pronounced your name incorrectly. I'm so sorry. I do try. So yes. Look, I'm very, very happy. All of you have, some of you have taken something from it. Look, guys, any questions? We are here to help. The support, the research team is happy to answer any questions you have. And look, be sure to register for the. All right, okay, we have one more question from Benson. Can one use only H4 to do analysis? Look, Benson, trading's quite a special business because there's no one telling you what you can and can't do. Okay, you have to learn, and you have to. It's a very flexible profession, which is very dangerous for quite a lot of us that are not disciplined. So you asking me, can you only use H4 to do analysis? Of course you can. No one's going to stop you from doing that. Would I advise that? Probably not. I always love, personally for me, I always love to look at the higher time frames as well. You could use the H4 time frame, the daily time frame, and the weekly time frame, and enter from the H4 time frame. There's one way of looking at it. But you have to work with a clearly defined trading strategy. Okay, that's clearly defines your entry and exit rules, clearly defines your risk per trade. Okay, that should be at least the very basic. That should be. And look, guys, you should not be trading live until you have something that works either on demo or you've back tested something. You should not be trading live, because what you're doing, well, I did, what happened to me on countless occasions, because I thought I knew better than my mentor, is I would trade live. I mean, I was trading quite a considerable account when I first started, and I was winning money. I was actually generating a return, but I was so close to blowing up my account, I didn't even realize it because I was very emotional in my trades. And the reason why I was so emotional was because I did not have the statistics to back up my thinking. What I mean by that is, look, perfect example, the Forex tester. I use that. I'm using that right now. I'm taking trades on that. I'm testing something I'm interested in, and only when I see that I can produce a consistent return from that will I then move to a small account live. Okay, that's how I work. I almost see the Forex tester as a driving license. So we all have to go and practice to get our driving license. Once you have your driving license, you're then free to begin your journey into learning driving, right? Into becoming a better driver. That's how I look at it. I look at the Forex tester as my license. Once I have that license, and I can then work with a small live account with the confidence that I have these statistics to back up my trading decisions. If I don't have that, I know me. I know what kind of person I am. I know if I have a loss, if I have 2 losses, 3 losses, I will begin to panic. I'll be thinking, hold on, this isn't right. Something's wrong here. Something is wrong. What do you do then? You change. Vicious cycle. And you'll never get out of that. You'll never remove yourself from that cycle unless you perform some sort of back testing or some sort of forward testing that can prove you have an edge. Okay. That's just my opinion, guys. That's how I work. I hope that was helpful. So anyway, look, right. So, okay, look, guys, on that note, thank you all so much once again for taking the time out of your, evening, day to attend the presentation. I really hope you took something from it. Have a great evening or day or afternoon, and I'll see you all again very, very soon. Thank you so much.